Have you ever wondered why the market rallies to a certain high or low and for some reason fails to break above that high or low? And on the flip side, it drops or rallies to another certain high or low and just expands exponentially, breaking above those key levels. This is something that when I started trading, I used to wonder why this was happening. Why is the market respecting a certain high or certain low? And then on the flip side, why is it not respecting a certain high or certain low? Why is it just disrespecting the highs or the lows exponentially? And a lot of the times I would take a trade. Let's say I took a trade for a buy, anticipating for a run on buy side, and then price goes very close to the buy side and just reverses on me and turns around, wiping my stop loss. This is one of the things that so many new traders are battling with, and they don't understand the reason why price keeps doing this. And in this video today, I'm going to share with you the exact reason why this is happening, and I'm going to share with you several examples both on the dollar, on the euro, and also on Ethereum, so that you can have a good understanding of what we call the high resistance liquidity and the low resistance liquidity. So the first one we're going to be looking at right here is Ethereum. And you can see that so far Ethereum created a high, a previous all-time high, dropped to the downside, expands to the upside, running liquidity from this previous high right here. The moment we took this liquidity from this previous high and dropped to the downside, this key level, this previous high, becomes a high resistance liquidity. And why is it a high resistance liquidity? The reason is because there is a run on external liquidity. Now, price coming back to these highs, it will find it very difficult to rally above this key level. And that is why you can basically see what happened right here. Price came up the first time and then it couldn't rally above it. It dropped, came up again the second time, and it couldn't rally above it again. It dropped again the second time, impulsively. The reason is because this key level is a high resistance liquidity. Now take note, I'm still very bullish on Ethereum, massively bullish. But this high resistance liquidity is a significant key level that I wouldn't be surprised that price will struggle to rally above these key levels. Eventually, I wouldn't be surprised. Eventually, I'm anticipating for a run on this buy side. But it's going to take some time, a lot of effort, volume for price to eventually gravitate above that key level. Now, this is one example from using Ethereum. I'm going to show you another example using Euro US dollar. So for Euro US dollar, you can basically see we have this low right here, and then look how price dropped below this low, running this external liquidity. After running this external liquidity, look what happened right here. Look how price came to the downside and then rejected. Because this is a high resistance liquidity, price will find it difficult to drop below this low. And then we came back again the second time, and then look what happened. We still failed to drop below that key level, and then we rallied to the upside. Now, on the flip side of things, look at all this. On the flip side of things, On the flip side of things, look at what the market is doing. So let me bring out the chart once more on Euro. So on the flip side of things, you can see we have this low resistance liquidity resting right here, low resistance liquidity resting right here. Look at this one right here. Look at how price literally exploded to the upside to rally, easily smash through this key level. The thing to take note of in this video today is these key levels are very significant. A lot of traders struggle to know areas to use as take profits, areas to use as stop losses. I've just given you the key right here. A high resistance liquidity is a very strong key level that I use for stop losses. Now, on the flip side, a low resistance liquidity, these are key levels that I use as take profit positions because price can easily smash through those key levels. Just the same way we have this right here. This is low resistance liquidity. There was no external run on liquidity here. Price came in here, mitigated it, and dropped to the downside. So I wouldn't really be surprised for a potential expansion after mitigating a discount and then a rally above this buy side liquidity. So I'll show another example using the dollar. So you can see the dollar right here. We have this low resistance liquidity. Look how price exploded to the upside to rally above the low resistance liquidity. And right here, we have low resistance liquidity. Don't be surprised, the market could play around. Even if we come to the upside, maybe to this key level, this will still be my potential target. So I hope you found some value in this video today. I hope this has cleared the air for a lot of traders battling with where do I put my stop loss? Where do I put my take profit position? This is it. This is the gem. This is the key. Low resistance liquidity is the area I use for take profit position. High resistance liquidity is the area I use for my stop losses. If you found this insightful, give it a thumbs up, follow for more, and I'll see you all on the next one.